Hi, I'm Lary Wolf, and this is Stuart Gross. We're partners at Roberts and Holland, and we've been talking about some of the tax simplification that came about because of the new tax law. The next section we're going to talk about is the exact opposite of simplification. It is probably the most complicated new provision and has new concepts, but if you can take advantage of it, you're really going to like it. This gives taxpayers up to a 20% deduction for their qualified business income. So your business income, if you're in the right business, you can deduct 20% of it. This has the effect of reducing the top tax bracket from 37% down to 29.6% on this particular kind of income. So this is income from partnerships, S corporations, and sole proprietorships, and it's in effect through 2025.
In the legislative back room, when the corporate tax rate got reduced to 21%, there were some legislators who believed that pass-through entities, which generate a large portion of the country's business activity, also were entitled to a break. And so this was their way of trying to increase the benefits in the tax law, reducing the top rate effectively, as Larry said, from the 37% to 29.6%.
So this was really backroom maneuvering, and in fact, real estate got a very big benefit at the, I'll call it the 24th hour. This was literally at the very last minute as part of a compromise to get this bill passed, and we'll talk about that in just a couple of minutes.
So I have a qualified business. Tell me, what's a qualified business?
A qualified business is any business other than being in the trade or business of performing services as an employee. So to the extent you're an employee and get a W-2 form from your employer, that income is not qualifying business income. It's not a good trade or business. There's another huge exception to be a trade or business, and that is specified service trade or businesses. And that includes health, law, accounting, athletics, financial services, brokerage services, or any trade or business where the principal asset is the reputation or skill of the owner or employee. What that means, we don't quite know. Now, at the last minute, architects and engineers, even though you might think of them in the service business, they were not included in this bad category of activities. So if
these specified service activities are the activities that are not eligible for the benefit of this 20% deduction.
That's correct, with one exception we'll get to in a minute at the lower ends of the income scale. So this is a strange one, and that last thing I said about architects and engineers taken out, when you read the provision that said where the principal asset of the business is the reputation or skill of the owner or employee, what's the architect supposed to do, Stuart? Say, I'm not skilled, I don't have a good reputation?
I thought I went to the architect because I thought that the person there was a very capable person with a great reputation, but maybe now they're not going to.
Well, we've heard informally from government officials who have been talking about this that provision about reputation or skill clearly couldn't be aimed at architects and engineers because Congress made it clear they don't want them involved. So we'll have to see how the Internal Revenue Service deals with this, and I'm sure they'll come out with a favorable rule in that regard. So there are questions as to, when I mentioned brokerage activities, is that a qualifying trade or business, and maybe not. So while we think they meant financial brokers, stockbrokers, we're going to need guidance to see if this applies to real estate salespeople, leasing brokers, and we'll just have to wait and see. Now, I mentioned that there was an exception to these rules. If you're in a service business, you're not excluded from taking advantage of this deduction if your taxable income, if you're an individual, is less than $157,500 or $315,000 of taxable income on a joint return. So if you are a partner in an accounting firm and you file a joint return with your spouse and your taxable income is less than $315,000, you'll be able to deduct 20% of your accounting income that you receive as a partner from your taxable income. So that's a big plus for what Congress thought they were helping the mom and pop type operations.
And this applies, of course, to real estate to the extent that you have a piece of property that qualifies as a trade or business, and probably the only kinds of properties that wouldn't would be either vacant land or triple net leased property in certain cases. But otherwise, the interest in real estate would qualify for this 20% deduction, subject to many of the other special rules that we're going to get into if your income is above that $157,500 or $315,000 on the joint return.
So that all sounds great. Now here comes a little bit of the confusing part.
You mean I don't just get a 20% deduction for the business income and that there are limitations?
That's what I mean. So what is the limitation? Now I'm going to say this, and we'll probably have to repeat it.
And I'm going to roll my eyes.
And you're going to roll your eyes, as every single person I have explained it to has done. I'll take a deep breath. The deduction is equal to the lesser of two things. One is the qualified business income from a qualifying trade or business. So it's the lesser of one or two. Two is the greater of A, 50% of the wages paid by that business, the qualifying business, or B, 25% of the wages paid by the business, plus 2.5% of the basis of qualifying property. Now, I realize I just said a mouthful. Real estate got a big benefit from that last addition relating to 2.5% of the basis of qualifying property.
So I can never get more than 20%, a deduction for more than 20% of my business income from this trade or business that we're talking about. And there are two ways that I can get as much as 20%, that full 20% deduction. One is 50% of the wages, and the other is 25% of the wages plus 2.5% of some number that you're going to explain further.
Right. Well, wages, we all know what wages are. That one's simple. Basis of qualified property, that's a little more complicated. This relates to depreciable property used in the qualifying trade or business. And basis for this purpose is the unadjusted basis of the property. That is basically the cost. You don't take into account depreciation. So if you bought a building for $10 million, even though you may have depreciated it down to $4 million, you would, in performing this mathematical exercise, take 2.5% of $10 million, even though, as I said, your depreciated basis is only $4 million. So this deduction, 20%, if you have the right mix of assets, wages, and the right kind of business, is a real boon. In the real estate field, many people have asked, what is a trade or business? And Stuart, that's a simple one, right?
We spent quite some time talking about that yesterday, and it is a very important concept. I think what's particularly tricky in this context is there are a lot of rules as to what is a trade or business. What becomes relevant under this provision is when you have one trade or business and when you have two trades or businesses. So suppose a person owns a rental property, and owns a gas station. Is that one trade or business, or is that two trades or businesses? Do I get to perform this test on an aggregate basis, which will provide a benefit in many cases, or do I have to apply the test separately? And the answer is?
We don't know. We don't know. But in the typical real estate investment situation, you might have a partnership for each separate rental activity. And the question is, if you're a partner in a partnership, can you aggregate all of those rental activities? Or are you better off if you have one holding partnership that holds all of the real estate, presumably in separate limited liability companies for liability purposes? Is that one business, or is that separate businesses? This is one of the areas that the government knows they have to give guidance on, and hopefully they will do that sooner rather than later. But it's a very important aspect, and we just don't know at this point how this is going to be interpreted, how broadly that is.
I think preliminary indications from the folks in Washington is that they plan on interpreting what is a trade or business expansively. And that's helpful both for the straightforward questions that we just raised, as well as for a number of more technical aspects of the provision. The bad news, I think, is that the guidance that Washington expects to issue on this kind of question is not likely to be issued until sometime in the middle of 2019. And that means that for the 2018 tax return filing season, it may be open season on what position people are going to take on their tax returns.
It also raises the question of, should I reconfigure my real estate empire, or do I need to? Because there's a lot of effort. You have to deal with lenders when you want to move property around to try to get everything into one holding entity to try to get a better view on what is one trade or business.
Right, and as an example of why it's advantageous to be treated as a single trade or business, if you happen to have one newly acquired property, and so the 25% of wages plus 2.5% test that Larry described yields a very big number, and you have a different activity, a different piece of property that is very old, has a very low basis, and you would otherwise run the risk of not being entitled to the full 20% deduction because that limitation of 25% wages plus 2.5% of the unadjusted basis didn't get you up to 20% of the income from the property. When you combine those two properties and you have the newly acquired property with the very high basis, you're able to qualify for the full 20% deduction. So that's an example of the benefit of aggregation and what's at stake and what is a single trade or business.
Look, to follow up on that, it's not uncommon in real estate circles for there to be a separate management company that will have all of the employees who work throughout the whole portfolio. And if the management company is a separate trade or business, you may not be able to get the benefit of wages paid by it in making these computations. If you can put the management activities into one big trade or business, you'll get the benefit of the wage portion of that calculation.
So just to back up a step, if I have a building owned by a separate LLC, and the LLC employs a management company and pays a management fee, that building may not have very much in the way of W-2 wages looked at in isolation. And so if you're paying a third-party management company, the only wages that you're going to have are whatever wages are paid by the entity that's owning the trade or business owning the building. But if you're paying a related party management company, that becomes a very important question as to whether you're able to count somehow, some way, the wages paid by the management company in the calculation of the wages for purposes of the 20% limitation as applied to the real estate.